Hello, chart watchers, and welcome to this Wednesday, December 5th, Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. If you're unaware of today's happenings and are wondering why every U.S. stock market-related investment in your portfolio is unchanged today, well, the stock market is closed. So before we get into all that, let's take a look at yesterday's closing prices and check out a few key sectors and industry groups. You can see yesterday the Dow Jones Industrial Average fell 800 points. The S&P 500 dropped 90. The NASDAQ down 283 points. And the Russell 2000 small cap stocks hit hardest of all, down 68 points or 4.4% on the day. 10-year Treasury yield. This was a big part of what was going on yesterday. A lot of money rotating back into Treasuries with the yield dropping. You can see down almost 7 basis points, was down below 290 intraday. Did manage to close back up at 2.92%, but in the process gave way support, yield support, closer to that 3% level. Volatility index, we've talked a few times in the past about how the last two bear markets, we never saw the volatility index go below 16. Literally, the VIX surged right off of that 16 level, rose 26% yesterday with fear returning into the market. The aggressive areas of the market were hit clearly the hardest. Financials down more than 4%. Industrials also down more than 4%, and technology and discretionary stocks both down just under 4% yesterday. Banks and life insurance companies, these are two industry groups that tend to get hit hard when yields are dropping, and that was certainly the case yesterday with the 10-year Treasury yield falling. You can see that banks down 4.77% and the life insurance companies down 5.11%. Both of these groups leading that action to the downside. Today, Wall Street has closed for a national day of mourning to honor former President George H.W. Bush, our 41st president. Today's special closure is rare, but certainly not unprecedented. Our video producer, Gretchen Pitluck, produced an excellent video providing the history of such special closures with my co-host, Aaron Swinland, narrating. They've done a wonderful job, so I hope you enjoy this walk through history.
The hustle and bustle of the New York Stock Exchange pauses for 9 holidays throughout the year. But for more than 100 times in the past century, the New York Stock Exchange has unexpectedly ceased operations for hours, days, or sometimes weeks. Over the years, numerous incidents have caused an unscheduled market-wide shutdown. We've compiled 10 notable closures throughout the years. World War I. In June of 1914, the assassination of Archduke Franz Ferdinand triggered a chain of events that led to the continent-spanning conflict. Operations at the New York Stock Exchange became stopped a month later until November 27th, pending the outbreak of World War I. Bond trading reopened with price restrictions, and restricted stock trading commenced a month later. Normal operations finally resumed in April of 1915. Black Monday aftermath. The crash of 1929 was not the single cause of the Great Depression, but it did act to accelerate the global economic collapse. There was nowhere to go but up, yet a small recovery did little to staunch the bleeding. Earlier that week, from Monday to Tuesday, the Dow Jones Industrial Average mounted historic losses, still the worst plunge in history. Within the last 5 days of 1933, President Franklin Roosevelt ordered the close of the exchange. There were numerous early closings throughout those years due to market volatility. Civil defense drill. With the uncertainty of World War II overseas, the U.S. government wanted to make sure the country was ready for any possible attacks on American soil. Taking 26 minutes total, this would be the first time that the New York Stock Exchange would stop for a defense drill. These drills also happened 7 times during the Cold War. Presidential deaths. With the death of a current or past president, the market and nation have come together to pause for the day. This has happened 5 times over the course of 55 years. The assassination of President Kennedy on November 22, 1963, caused an early market closing at 2:07 p.m. Paperwork crunch. Too much paperwork caused the market to take Wednesdays off in the late 1960s. In 1968, the New York Stock Exchange found itself sitting on more than $4 billion worth of unprocessed transactions. Even in the heavy volume days of 1929, trades never rose above 16 million shares. Now, trading had risen to 21 million shares daily. National Day of Participation for Lunar Exploration. One small step for man, one giant leap for mankind. The day after Neil Armstrong uttered those words as he landed on the moon, Nixon gave the country the day off to celebrate. The New York Stock Exchange closed accordingly. October 1987 panic. Rocky trading, which began in Hong Kong and spread west to Europe, eventually rippled to the United States, scaring traders as the New York Stock Exchange opened. The Dow Jones Industrial Average fell exactly 508 points, or 22.61%, to 1,738. This date in the finance world has been coined Black Monday, referring to when stock markets around the world crashed. From October 23rd to October 30th, heavy volume forced the New York Stock Exchange to end days earlier at 2 p.m. First circuit breakers tripped. Regulators put the first circuit breakers in place following the market crash of October 19th, 1987. 10 years later, and for the first time, circuit breakers were triggered as the Dow fell 554 points, or 7.2%, closing U.S. markets early. Natural disasters. Weather has had a history of causing market closure over the years. As Hurricane Sandy raged against the eastern seaboard, it closed the New York Stock Exchange for 2 full days. In fact, the last time the market was closed for 2 consecutive weather-related days, it was more than a century ago when the New York Stock Exchange kept its doors shut as the city braved the blizzard of 1888. 9/11. As tragedy hit the United States, 9/11 became the longest shutdown since 1933. A terrorist strike in Lower Manhattan, which destroyed the Twin Towers and cost more than 3,000 lives, temporarily disabled the U.S. financial system. Even after trading resumed on September 17th, the Dow Jones Industrial Average lost 684 points, a 7.1% decline. The exchange also closed exactly a year later to mark the anniversary of the attacks.
Okay, welcome back, everybody. That was an excellent piece. I have to admit that some of that was discussed during that video I was not aware of. And so, again, I just want to give a shout out to Gretchen Pitluck, our video producer, did a really wonderful job putting that together. And Aaron, you did an awesome job with the narration. Did you know about everything?
Absolutely not. I did not. There were a bunch of them I did know. I wasn't aware of the paperwork one, for sure. I wish I could close down when I have too much paperwork.
I do close down when I have too much paperwork. That's pretty funny.
Mm-hmm.
Yeah, I wasn't aware of it, but I thought, and I have never seen a piece put together like that. Again, I thought it was very well done. I thought very professional. And again, I want to, say Gretchen did a great job putting that together. And I think everyone out there probably saw something maybe they didn't know about our history on Wall Street.
Yep. I think I'm going to try and get up on the Market Watchers Live Facebook page so everybody can share it.
Absolutely. Well, we got a very special show today. We got a couple of guests coming on with us. First, Gatis Roze. Gatis is joining us to do about a 45-minute presentation. So I know everyone is excited to hear from Gatis. Gatis, how are you doing today?
Oh, just peachy. Thank you. I'm excited for being here.
Yeah. Did you know everything that went on? I mean, I know you follow the market really closely. And if there's anyone here that's, that I would think maybe does or did know everything, maybe it's you. Were you aware of everything that's taken place there?
Gosh, you really hooked that one, didn't you? Moving on.
Okay, we'll move on. Well, we'll move on to our other special guest, Greg Schnell. Greg is going to be joining us, and we'll be giving everyone an update on the Canadian markets later in the show. And also we'll join Aaron and I to give you maybe a couple tidbits of some of the things we're looking at in terms of 2019 forecasts. And Greg, how are you doing today?
I'm all good. Happy to be here. Thanks for the invite.
Yeah, actually, Greg and Gatis are both in our studio out in Seattle. And so they've got kind of a little advantage. They've got kind of the home court advantage over Aaron and me, but we're going to try and hold our own during the session, no doubt.
The two Canadians against two Americans. This is like a little hockey game here.
Well, I don't want to
I
point
know my
out-
team's always winning, so that's great.
Yeah, when
I would like to point out that Seattle did just win an NHL franchise. That's a big, big deal.
yeah,
I'm excited about that.
very exciting.
I'm-
I
I'm-
also want to point out one thing. What was the last year that Canada won the NHL Stanley Cup?
Bullet delivered.
1805. I don't.
Bullet delivered. I like that, Schnell.
Yeah, it was bullet delivered there. Huh, nice. Nicely done. But just so you know, Seattle's already won a Stanley Cup, and they're just getting an NHL team. So put that in your hat.
Seattle Metros, the Seattle first American team to win the Stanley Cup. Well done, Greg.
Wow. So what's the nickname for the Seattle team?
Well, I've heard everything from the SeaTax to the. There's a whole bunch of stuff going on. We'll wait and find out. They're going to have a naming competition, I think.
Well,
I
think
was
one of the
thinking
issues-
seahorses.
Oh my gosh! One of the owners happens to make movies, and one of this little bit of scuttlebutt is that one of the options is one of the monsters from one of his movies, which let's hope that doesn't happen. But
Be like the Anaheim Mighty Ducks there for a while.
Yeah, exactly.
I don't know. I don't think we're going to come up with the name today, so we better go ahead and move on. But Aaron, I know we got a few things lined up, a little different show today. What do we got today?
All right. Yes, it is really a special edition here of Market Watchers Live, but let's go ahead and take a look at what's going to happen the rest of the week. Friday, we do have Mary Ellen McConigal coming in for What's Hot, What's Not to co-host. And we have Tom's Workshop next week on Tuesday. Greg Morris joins us on Wednesday. So it should be a great week. And oh my goodness, we have Bill Shelby also coming in. He'll be coming in on Thursday of next week. So lots lined up today. Like I said, special edition. So we're going to start off with our special guest, Gatis Roze. He'll be telling us about Morningstar. And then we have Greg on the Canadian markets. He'll give us an update. And then we're going to just round out the program with our market outlook for 2019. So we'll see who is the bearer of good news, who's the bearer of bad news. I think you might be able to guess already if you watch the show.
Maybe, maybe not. Never know. All right, let's jump into the economic headlines today. First of all, obviously, the U.S. stock market is closed, as we mentioned. And later today, the Beige Book will be coming out in less than 2 hours, 2 p.m. Eastern Standard is when that is scheduled. I want to bring up the 10-year Treasury yield, and I'm going to do it this time in a fashion that shows you the correlation between the 10-year Treasury yield and the S&P 500. And hopefully you'll gain some understanding into why I like to see the 10-year Treasury yield moving higher, especially when it's in a fairly low area from a historic perspective. I mean, when you look back at history, 10-year Treasury yield down at 3% is pretty darn low. And so moving it up a little bit wouldn't be a problem. But if you take a look, here's the 10-year Treasury yield. This is just going back through the bull market, last 10 years or so. You can see what kind of looks like sideways action. You look at the S&P and it's moving up, and you might think, well, there's really no correlation here. Well, if you pull up the correlation indicator at StockCharts, TNX versus the S&P, and you do it using 20 periods, and of course, this is a weekly chart, so it's over each 20-week period, what you're going to find is that for the most part, we are in positive territory. Is there an exact, perfect positive correlation? No, there is not. But the fact that we spend most of the time in positive territory makes sense to me because, first of all, you've always got money coming in. New money is always coming in the stock market, into the bond market. So it's possible that the S&P 500 could go up and Treasury yields could go down at the same time simply from new money coming in. But what really drives the market, in my opinion, is the rotation that we get between the Treasury market and the S&P 500. So, for instance, when we start to see big moves in the yield to the upside, it means that money is rotating away from Treasuries and into the stock market. And I think that's perfect, and is perfectly explained here in the correlation factor. So that was just one thing I wanted to point out. I think if you go back in time, you'll see that that is a long-term positive correlation as well. And it's something we need to keep an eye on, which is why I'm not a big fan that we are seeing this 10-year Treasury yield begin to break down, we need to hold on to that support on the S&P 500. Okay, let's go ahead and bring Gatis Roze back in. I know, Gatis, you've got a presentation ready for everybody. Everyone's anxious to hear it, so take it away, my friend.
Well, you may be sorry you're bringing me in, but I mentioned that the issue here in Seattle, when you have a hockey team, NHL, owned by a producer like Jerry Bruckheimer, whatever his name is, one of the monsters in his Pirates of the Caribbean, I think, was called the Kraken. So there's a famous line about "Bring on the Kraken." Well, one of the names they had talked about was the Seattle Kraken. I'm not sure that goes over well with the double entendre going on. So the names actually that get bantered about the most are like the Seattle Emeralds, or the Totems, or using the Seattle Metros, which was the old name. So there's some interesting names. Hopefully we won't be called the Seattle Kraken, though.
Yeah, I doubt they're going to pull out the Supersonics from basketball.
I hope not. We're hoping to get I'm actually number 8,120 on the season ticket waiting list. So a lot of people signed up knowing that they would have first dibs on a basketball team when we eventually get one. So that's a good motivation and exciting sort of stuff. Anyway, big news here in Seattle. But I've been using Morningstar since the first year as one of my primary tools. I've been using StockCharts, obviously, since about 99, 2000. So I thought it would be interesting just to talk a little bit about how I use this tool. You might find it interesting, and it is a powerful tool. So the usual disclaimers, I've used it for a long time. No, my uncle doesn't work there. No, I'm not being paid anything for the presentation, and I'm not responsible for what you do with this information. So read the fine print, email questions to Morningstar. The disclaimers apply to all the lovely individual investors listening in. If you happen to be a grouchy investor, it applies to you as well. So Morningstar has, much like StockCharts.com, it does have a free limited user base. It also note that you can get premium Morningstar generally free through your library. The third option would be check with your brokerage site, because many of the brokerage sites, I know a couple of them, my brokers actually use Morningstar data. Another option is they have a 14-day free trial, so you can do that. And I'm going to demo, I'm a premium member, I pay for it. I'm not even sure what I pay. I think it's like $20 a month or about $200 a year. So I'm going to demo everything to do with the premium services. So this is basically the home page. If you scroll down to a little bit in the home page, you can see the 4 pods that is Morningstar: stocks, funds, mutual funds, ETFs, and then bonds. So let's talk about stocks initially. They cover about 4,000 stocks. Now, this is your stock page. Note they have mobile access now, which is available on your smartphone, which is great. The site for stocks is ideally oriented for value investors. It has minimal charting, and its whole orientation is about towards the value investor. I am not a value investor. I use Morningstar for value investing. For that asset allocation pod, I use mutual funds like the Yachman Fund, which is a value fund. So 19 of the asset classes that I personally invest in, I either use ETFs or I use mutual funds. The one asset class that I trade actively is large cap stocks, but I do not use Morningstar very much for that. And one of the reasons is if you look at General Electric, for example, if we happen to put in General Electric here just as a stock, they're rating General Electric right now as 4 stars. Back November 13th, they had rated it as 5 stars. They actually rated Enron as 5 stars just before it went belly up. So there's a reason that I'm not really a big fan of, so that's the bad news, a big fan of using Morningstar for stocks. It's simply not the kind of investing that I do. They do have an ETF which has done pretty nicely. It's based on their strategy of moats, having companies that are surrounded by wide moats. And the ETF on that is MOAT. And it's actually over the last, since 2012, the NYSE was up 55%, and this MOAT was actually up 142. So I'm sure Morningstar gets a royalty for letting them use that. But I just don't see it for stocks. When you have a stock like General Electric that was at $30, and now it's down at $7, and they're rating it 5 stars or 4 stars, not my kind of stock. So we'll move on. But if you're a value investor, good stuff. One of the foundations, I'm going to go to this page here. One of the foundations of all investing, I think, is you have to start with asset allocation. So this, I'm just showing you my blog, the Trader's Journal blog that I write with Grayson. If you click on stage 1, which is all the blogs that we've written about asset allocation. And an example of this is on October 23rd, 2015. I've been writing this since 2012. It talks about the different kinds of equal weight strategic asset allocation, or you can do a fixed mix and or tactical. Those are things that you really need to get down first. And then understanding that, then you'll be able to really utilize Morningstar to its most effective, really use it as a high leverage tool that it can be. And asset allocation from an individual investor standpoint is probably the number one high asset. We actually wrote, you can see here that Grayson and I put together this video. We were hoping to have Wiley put it in our book, but they ended up saying that the book would be too expensive. So we ended up not doing that, which was a shame, but you can actually pick that up. So enough about the stocks. I'd like to move on to ETFs. So this is your homepage for Morningstar ETFs. And I'd like to point out that they have started rating now ETFs and medalists. So it's a wonderful place to go and look at whether you're looking for an ETF in a specific asset allocation basket or doing a comparative. It's really a very useful tool. So that is one area that I do use Morningstar a lot with ETFs. They've rated now about 400 ETFs, and I know in the chart pack that Grayson and I put together for StockCharts users, we've actually put a lot of their top rated ones in that chart list. So it makes it easy for you to see that. So if we go back to that main page, the other list that I like very much is just looking at ETF returns. Looking at this list and whether you're looking at 1 month returns or let's say 3-month returns, you can see which of the ETFs are hot. Where is the money flowing? It's almost like a breadth indicator. You can see all the way down the list. So it sort of answers. This is something that I do on a weekly basis. I like to go in and see what's happening. I think it's very insightful. If you're a shorter term trader, then go ahead and go back to the 1 month returns. I sort of bounce between the 1 month and the 3 month. Then the other thing that I like to look at is their analyst reports. These, when you've narrowed down a specific, you're sort of focused in on a specific ETF, these can help you get a full report and get an idea of what their analysts are saying about its suitability and its fundamental view You can see they have this big thing about what they say is the fair value. I like the pros and cons. It's always good. I use this in parallel with ETF.com, which is another free site. My experience is it seems to run a little faster if you register, but there's no expense involved, and it's a useful tool. So looking at these analyst reports, I find that to be a really great tool. If we go back, the other tool that I do like to use is the cost analyzer under ETFs. So load, please. Thank you. So if we go and well, let me skip that because I think it's going to take a little more time than I'd like to explain how all that works. But if we go to Analyzer and then go to Tools, I think that's what. Here you have some wonderful calculator screening tools that I do use, I do find useful. But again, I find them useful used in parallel with ETF.com, which is sort of my go-to tool, and using them. They also Morningstar does publish hard copy, something called Morningstar ETF Investor. It's a great publication. It has all their top-rated ETFs listed. They call it their equity watch list. It's done by asset class. It shows you the fees, the stars, the analyst ratings, the performance. I'm a Sunday afternoon, put up my feet and read. So I like to do that exactly with the hard copy. But let's get into the meat of it. This is what I use the most, the Morningstar mutual funds. That's what they started doing many, many years ago, and they keep improving upon it. I don't think there's anybody out there that's as good as they are. And again, your broker's using a lot of their data as well. Well, I should have. This is an issue that has happened before when they try to get me to it logs off, for example. See, I'm in right now. I'm in funds, and I go to Morningstar Medalist. So it should take me there, shouldn't it? But it doesn't. So that's a complaint, if you will, that I have. So we may have to skip over that. Let's try medalists by category. I'm logged in. What's going to happen? Medalists by category. Terrific. Well, let's try to do the slow way, and we'll have to sign in. I apologize here. Sorry for the silence. Okay, so now we go back down into funds. And let's try again with the medalist category. Does that? No. Well, there's a glitch. Nice complaint. So let's try something else. We'll try the analyst ratings. Does that take me where we want to go? Oh, you love this technical stuff. Okay. Well, we'll pivot a bit here. Since we can't get medalists, all rated funds, here's a tool that is really very, very powerful that I've used to put together my best of breed for each of the classes that I have. For example, one of the asset classes that I do invest in using mutual funds is mid-cap stocks. So I'm looking for mid-cap mutual funds, and the way that I do them is I sort them by performance. and then click on the 10-year because I'm looking for something longer. And I have to admit, I do own this Prime Cap fund, and I've owned it for a long time. Unfortunately, it's closed, but Prime Cap still has 2 funds that are open, and we'll talk about that a little bit. But let's go to this Prime Cap fund. So this is the page that shows you, has all the tabs to show you what it can do. One thing very powerful you'll notice up here on the fund family data page. It's an interesting, if you haven't noticed this, what this shows you is it shows you the Prime Cap funds, all the funds here that Prime Cap runs, and it shows you what their most common investments are, where their top U.S. holdings are. You can do this for any of the funds, but Prime Cap, it's a wonderful little button, and because Prime Cap is such a gold star kind of house, I do like to check on it. Obviously, this is what most of us go to the PDF file, and we go to this page, which is a very powerful page, shows you what their assets are. You can see here their quartile performance over the years, and then what kind of percentile rank. I like to focus on this tax-adjusted returns, because it's what stays in your pocket that really matters. So this is what you have your analyst writing what I usually print out and stash in my, I'm still an old school, I still use binders. Another thing, another really key button is this purchase button. You can see that in this case, we have Prime Cap Odyssey only has one class of fund. And if you hover over it, it'll give you the symbol POAGX. That is not true for many of the different funds that are out there. There are some American funds, for example, that have, I think they have about 13 different classifications, and I'll show you just put in a ticker symbol here. You'll see that this can really save you a lot of money. Here you have one fund. Now understand, guys, that this is the same fund in 17 different flavors, 17 different tickers. It's all the same portfolio. The only difference is they differ by the expense structure. So if you go down here and compare CGFFX over the life of the fund, you've actually been up, the fund's been up 310%. If you compare it to another GFACX, same fund, different expense structure, you're only up 263%. That's an 18% return, higher return, simply from the fact that you're picking the right flavor. So that's why I think that little button there is so critical about understanding. Oh, the other thing, you can look down here and it'll tell you where you can buy them. But if you go to different funds, there'll be a much larger list. So this is a very, very powerful list, I feel. I'm going to go to, we'll sort of focus on the Prime Cap fund, just because I like to look at it because the performance is nice. But so I've showed you the family button. You can look at charts, you can do the fund analysis. Then they also have a wonderful performance button here that you can expand. So it can show you how it's performed relative to the indexes. It can show you the percentage over 3-year, 5-year, 10-year. You can see it's finished in the top 1%, and then some other lovely data. The risk and ratings page is very powerful, especially when you're comparing different funds. I like to print this off. And then management, notice that the guys that are listed here as the managers, there's 212 since 2004. Also notice their background. These are top tier schools. These are top tier managers. They've been around a long time. That's the way that a great mutual fund is run. And PrimeCap, I think, is an example of that. Stewardship is a rating that Morningstar has applied to the actual mutual fund house, the PrimeCap money management house. And they get glowing reviews. In this case, we can look at the portfolio and see exactly what their holdings are. I like to go in and see what the holdings are each quarter for the top funds that I own, because when I go to track, when I own a mutual fund here, and you can see their top holdings are not the Amazons of the world. They're significantly different than what you get the vanilla funds. This is a mid-cap fund, though. You have to remember that. Much like Graceland and I do with the chart list and looking at Fidelity Select Sector funds, looking at what they buy and sell at the end of each quarter because they have to report that, I do that the same with the top funds, looking at where are they moving money, what are the equities they're buying and selling, and I find it to be a very powerful, provide some very powerful insights. Obviously, the expense button is really, really important. I only buy no load funds, and I make sure that I'm minimizing the expenses. You can see here, this house, PrimeCap, also manages a number of funds for Vanguard under the Vanguard PrimeCap label. But as I say, there are only two that are still open. Now, one of the nice features here is something called find a similar fund. So when you want to find a similar fund to something like POAGX, which is closed, you input the fund that's closed, and it'll give you a list of alternatives that are most similar. So we know that PrimeCap's closed, so why don't we take a look at some others that might be similar? We can hit this performance button. It'll show you the performance compared to its sort of sister funds. And then you can do some homework and say, okay, well, unfortunately, I can't get into this fund, but loading quickly, isn't it? My apologies. Okay. Well, let's take a look at, oh, there it goes. Okay. So you can see what the performance, some of the funds don't have 10-year performance, but you can see why I'm invested in the PrimeCap Odyssey Fund. 10-year performance, 21%. It outperforms all its brothers and sisters. So a very nice fund. But another very powerful tool I feel that I use quite a bit is called Fund Compare. This is free. This is a tool that all of you can use. And in this case, let's say in the mid-cap space, that what I just showed you, if we enter a couple funds, you just enter them here in the box, and then we can do a number of different kinds of comparisons. So there's your three funds, three mid-cap funds. We're going to show the comparison. How do those three funds compare? Well, you can see all of them are pretty darn good funds in the mid-cap space. We can look at some risk and tax data on them, compare them that way. We can look at their portfolios, compare them that way. We can look at some nuts and bolts. So it's a very useful tool to very quickly compare whatever, and as I say, it's free. It's a great tool that way, simply because it is free. I wanted to encourage you. I'm looking for my notes here. The two Vanguard, two prime cap funds that are still open, which I would really encourage you to look at, because I think they're long term. That they're low expenses and they're wonderful funds. Here's an example of what that is. The ticker is POGRX. So this is a fund that is a prime cap fund that is open. You can see here that it over 3 years, 5 years, 10 years, over 10 years, you've had a tax-adjusted return of 15%. Notice the R squared, because if you have an R squared of 1, basically you have an index fund. So what are you paying for? But you can see their long-term performance has been very, very good. It's a low turnover fund, so it's not you don't get a lot of distributions. And you notice that most of the time here, it's in the top 2 quartiles versus its brothers and sisters. You can see too that the expenses are low, and it's a wonderful fund. I would really encourage you to look at that fund. Also, when you go down here and hit purchase for this fund, you'll notice once again low fees, but you only have one ticker symbol, POGRX, unlike that American fund that I showed you, which had a zillion ticker symbols. So that's very different. Another really key function of Morningstar, a really powerful function, is something that's their portfolio manager, which has some unbelievable tools built in. What I've done is I've loaded the 20 asset classes that I invest in, and I've just loaded in mostly ETFs to show you how this works. You would load in your portfolio, and then you would be able to look at different views. For example, you can see here, in this case, this is just a fictitious, everything's 100 shares, but this does represent all the 19 asset classes that I invest in. Then you can look at, create my view. So there is the view that I created, and looking at different parameters, percentage returns and 3-month returns and that sort of thing. You can have a number of different return views, very powerful. And this is all very easy to lay out. So from a portfolio manager standpoint, I think it's a really powerful tool. It does a couple things. It does portfolio monitoring. It does this X-ray function, which I'll show you in a second. It does X-ray interpreter, which is very powerful. I'll show you that. It's really, this tool is worth the entire price of Morningstar. So what X-ray does is it takes your portfolio here and it unbundles it. So when you hit X-ray, let's assume that your entire portfolio are these 20 asset classes. So it shows you where your portfolio's invested globally. In this case, because we're dealing with ETFs, American ETFs, you can see it's not terribly global, but it shows you the largest positions, and then it allows you to do different kinds of cuts. So here we're doing the X-ray overview, but you can hit X-ray details, and then it breaks it down even further. Or the X-ray interpreter, this actually gives you some insights from an asset allocation standpoint to say, hey guys, here's maybe what you should look at. And then a tool that I'm always shocked to find, when I run this on my own portfolio, which about 10 years ago I did this, and my largest single position was Berkshire Hathaway. And I did not own any Berkshire Hathaway directly. But because the mutual funds and ETFs that I owned, because of those, suddenly that was my biggest holding. the usefulness of this tool is that this is what you already own indirectly through ETFs and mutual funds. So if you're going out there and you say, oh, I'm going to buy United Health Group, well, maybe you need to look at that a little closely because you already own a big slug of United Health Group. So that is how I use this list, by unbundling my portfolio and looking specifically at my positions. The other thing that will shock you sometimes is the percentage of cash that you're holding that you don't even realize you're holding, because mutual funds hold cash. And so this is a great tool to give you that kind of insight as to what is being held by your particular fund. I think what I would like to also pitch you on, if you will, is there was a blog that I wrote some time ago. It was in March, and the title of it was "Why ETFs Are the Best of Breed." And what I'd like to show you is just discuss some of the things I discussed in that blog, because it'll make sense. What I point out is that in my own search of the blogs, in half the cases, in half the asset classes, the best of breed are ETFs, but the other asset classes are represented by mutual funds. So let's see, blog articles. I think I'll just use. Okay, this blog is worth looking at because it shows you why a tool like Morningstar is so valuable. Because I maintain these kinds of charts for all of my asset classes, and the benefits in this case, what I'm looking at is mid caps. The green line is always the Vanguard Total Stock Market Index. And then the other lines are, they're always ETFs. In this case, JKG is the mid-cap ETF that I thought was the best breed of all the ETFs. And then you can see what I do is I load it with sister mid-caps and compare them. So when somebody comes to me in the mid-cap area and says, Gatis, you should look at this ETF or this great new mutual fund, I just quickly put it on my best of breed chart and see what happens. Well, you can see here that compared to the market or compared to the best ETF, I should own the orange fund, shouldn't I? Which is prime cap aggressive growth, which is what I own. So this is the way that I'm always making sure that I'm in the best of breed, whether it's ETFs or mutual funds, and I use Morningstar for that purpose. Here's another example. This is biotech. One of my asset classes is biotech. I just feel as though 10 years from now, they're going to be up. I mean, they're doing extraordinary things, but I don't have a big staff, so I have no staff. So I'm just choosing myself how do I want to invest in this? You can see that I have mutual funds. You can see the market here. The best ETF I have found is XBI. So I use the XBI ETF for covering the biotech area or asset class, and I do not use a mutual fund because, as you can see in this case, the mutual funds have not, there isn't a mutual fund really that's outperformed XBI. Now, there are other reasons. When I go to look at comparing a particular basket of ETFs, or in this case, let's say biotech, let's focus on biotech, I will go to Morningstar, go to their ETF section, look at what they are saying are the best biotech ETFs. Then I will go to their Morningstar biotech asset class for mutual funds. And I will also go to ETF.com. ETF.com is a wonderful, I'm not going to go to the site, but I would encourage you to check it out. It offers you sister ETFs. So if you input XBI, it will offer you similar ETFs in that asset class, and you might go back and compare those to what it is you're looking for. So this blog, I would encourage you to take a look at this blog, because it's really the foundation of my investing strategy, if you will. It all starts with understanding your asset allocation, understanding which of the, in our book, for example, Grayson and I winnowed down the hundreds of asset classes that Morningstar presents, and the thousands, literally thousands of asset classes that ETF.com presents. And we winnowed it down for the book to 59 asset classes. Those 59 cover everything you need to be completely diversified. And then in the book, we calculated our correlations to the market for each of those asset classes. And then we put together in my case, as I said, I have 20 asset classes, and it's run exactly like this blog describes. We actually, in the chart pack, let's try that, see if that works. This is the chart pack that Grayson and I put together each quarter. We update each quarter with the latest holdings. And so this magically downloads, if you have a StockCharts account, it magically downloads 96 chart lists. But one of the chart lists has all 59 of those asset classes that allows you to really dig in. So from there, I identified the 20 asset classes that I use, and then 19 of those are ETFs or mutual funds. And as I said, my large cap, U.S. large caps are the individual equities that I invest in. Those generally are, I don't go over 10 positions. If I want to buy something new, I'm basically saying, okay, which of the 10 positions that I have do I get rid of before I would buy? So my point here is that there's a lot of thinking that goes in building, foundational building, before you jump in with both feet and start using Morningstar and picking, whether it's stocks, if you're a value investor, or picking ETFs or picking mutual funds. It is a great resource. And it is worth, as I said in the early disclaimer, I'm not, I feel as though those two services, StockCharts and Morningstar.com, are worth paying for. Now, you can also go to the library and get it for free, or check out your broker and see if that works. But I'm sort of curious to try the go back to my ETFs and let's see if that works again. Or, well, okay, so there you go. You can get their medalists. You can see what their returns are. They do it by category, so you can group them by category. So if you're looking at a particular U.S. large cap growth stocks, you see here you go. So there's an ETF. So there's an ETF that you want to compare it to. There's some really wonderful mutual funds out there that invest in this space. And so that's how you would use Morningstar. Let's try this valuation quick rank. Remember I showed you that? No, it's going to take us back to the quick rank function is really powerful in the mutual fund area. I use it a lot. I think it's just a fabulous tool. So if you pick another and this one is not a premium tool. This is something that that is free, and all of you can use that. So if you do pick another category, let's say you want a balanced fund, what do we see there? Well, it's a great tool for generating ideas. It's also a great tool for validating your existing position. And no coincidence, obviously, I knew I was going to the 50 to 70 equity, but this is a fund that that I've owned for a long time as well. It's just one of those fabulous T. Rowe Price funds. You can see it's 5-star. But you too could find this fund. Look at these, you know, number 1 over 5 years, number 1 over 10 years. And the main thing is on a tax-adjusted return basis over 5 years, it's in the top 1% over 10 years. So these people aren't suddenly going to lose all their IQ points in overnight. So these are the kinds of funds that you want to be into. And you want to use the power of that best of breed graph, if you will, to find these kinds of. I was going to take you back to my my own portfolio and show you the chart list that I have, which this shows you. Well, we'll take a look at it here. So here are my asset baskets. So these are the asset baskets that and this one should look familiar. I showed you that. It's the mid cap. Best of breed. This shows you that prime cap fund again. But I do this for, I showed you the biotech. So you see how I maintain these funds. We looked at U.S. allocation. So in this case, obviously, as you would expect, there's your T. Rowe Price. It's up about 150 versus the market, but look at the volatility is much less. But look at its sister ETFs, sister mutual funds, and the black line is the ETF, the best ETF out there. These are sister mutual funds. And this was all constructed using the Morningstar tools. So I would really encourage you to put these kinds of charts together, maintain these kind of charts, and it allows you very quickly to look at ETFs or mutual funds and compare them to the best of what is out there. Anyway, I think we've covered what I wanted to cover here with you for Morningstar. Let's take a look.
Gatis, can you just show people how the settings on your chart?
The settings obviously vary. Now, if you were to put in, I hope some of you are familiar with this, but if you were to put in a stock up here, let's say Amazon, and then you pull down the chart styles at the very bottom, I'm below everybody, but if you'll find my name, and then what you get is this tensile trading. Grace and I call this the tensile trading format, because you're comparing in this top chart, you're comparing how is Amazon doing relative to VTI, VTI being the market. How is it doing? How is the sector that Amazon belongs to? How's the sector doing relative to the market? Then you look at the industry group that Amazon belongs to. How is the industry group, because sectors are made up of industry groups, how is that industry group doing and relative to the sector? And then the bottom one is how is Amazon doing relative to its brothers and sisters in that industry group? So this is a format that you can change the ticker, pull it up very quickly. And then the other thing that I'm very big on is money flow. So I'm looking at on-balance volume and shaken money flow. So being a white coffeean, I'm a bit of a volume junkie. But this is my go-to layout for stocks. For mutual funds, it's slightly different. And again, I've saved these little, see down here, if I hit mutual funds, it gives me a format. I'm looking at how the Sequoia fund is doing relative to the market, and it's underperforming the market. But then I'm looking at momentum, and then when is it issuing dividends? For those of you that might be a little more newbies, this is something you really need to focus on, because if you use a little inspection button, go down here, and you can see that Sequoia fund has paid, in the past, has paid distributions on these particular dates. So they just paid one November 19th. That's something that you should know, because the worst thing you can do is buy a fund on November 17th, and then 2 days later, they have a 30% distribution. And this year, the distributions are going to be pretty significant. And you get your money back in taxable form. So this layout is something I think if you own mutual funds, it's something that you really, everybody should be aware of this. Anytime you look at buying a fund, please be aware of their sort of historical distribution dates. And I will tell you, ETFs also, don't think ETFs don't have distribution, especially the crazy leveraged inverse. Those guys, they're meant for day traders. They're not meant to be buy and hold for a long time. So do check the historical distributions on that, because that can be really painful. So hopefully that gives you a bit of a summary on how I've used Morningstar. As I say, my uncle doesn't work there or anything. I just think it's a great tool. For the folks that have used the freebie service, they inevitably migrate to paying it used to be $10 a month, or going to the library and using it. So great tool, especially when you're used with stock charts in tandem. Fabulous. It's like 1 + 1 = 3. Anyway, that's a bit of a recap.
Great. Well, appreciate that.
I should say I don't use it for bonds. I'm sorry. I don't feel like I'm old enough to buy bonds, so I don't use the fourth pod in Morningstar, which is the bonds. That's it.
Yeah, very nice presentation, Gatis. I do want to say, looking at the overall market and with all this volatility, I know to some extent you kind of ignore that, but Greg and Aaron and I are going to talk a little bit about 2019 market forecast. Do you have any thoughts next year and everything that's happened, here in the last couple of months?
Let's just focus here in December, because I said this earlier. The distributions this year for mutual funds are going to be very significant. And a number of funds I've taken off the table. Again, I use Morningstar for this. Morningstar sends me an alert to say, Harbor International, which I'd had for 20 years and done very, very well, they fired the previous manager. Well, we see this with the chart pack. We see this all the time when Fidelity changes their portfolio managers in their sector funds, and the new manager comes in and sells everything that the old guy had. Years ago, this happened with Fidelity, with Magellan. And they had this huge distribution of like 33%. And I had a gentleman in my class that happened to have the misfortune of buying that on Monday when they had the distribution on Wednesday. And he got literally $30,000 of his own money back in 2 days in taxable form. So I'd like to focus on, be aware that of what I just pointed out of the distributions for both ETFs and mutual funds. Things like the Harbor Fund that I mentioned, I sold it and before they, because the new manager was no doubt going to make some huge distributions. There have been a number of, the Fairholme Fund is another example that I sold quite a few months ago for management changes and just performance and those sorts of reasons. So I'm really in December, I'm not much of a buyer in December. The other thing I'm really focused on earnings, and the S&P earnings are doing pretty well. So I'm not jumping off off the ship. This year we've had 5 higher lows. Every retest has been higher. Yes, it's been a retest, but each of those retests has been at a higher level. So I take seriously the sort of double bottom that we've had here over the last 2 months, and I'm sort of looking for insights from that.
Okay. Well, we pulled the poll up regarding Morningstar, and you gave a great presentation on how you use Morningstar. And it looks like of those who use Morningstar, they do use it mostly on like a monthly basis, which kind of makes sense, seems, based on a lot of the information that you provided.
I hope that they would use it once they understood that XRay function and the portfolio management function. I would hope they move from monthly to maybe bi-weekly, okay, every 2 weeks or so, because the XRay function is truly an amazing tool worth the price of admission. So I would really encourage those people. But then you have to look at this poll. I mean, 17% of people answered, "Why is there error?" So, you wonder even more than those that study weekly or daily. So,
yeah. Well, it's always a pleasure having you on here, Gatis. I really want to thank you for stopping by. Kind of an unusual day because the market closed today. We certainly weren't expecting that. But always a pleasure having you.
Traffic was light getting here, so that was the good news.
That's true. Yeah, banks were closed. I'm sure there were a lot of folks maybe all had the day off today, so maybe that's helping traffic around the country. I don't know.
Yes. Well, happy holidays to you all.
Yes, same to you and your family, and hopefully we'll see you soon. I'll be coming out there next week.
Oh, good.
I don't know if you're going to be around the office at all, but if you are, hopefully I'll run into you.
It'd be nice to cross paths with you.
There you go. All right. Well, have a great rest of your week. Thanks again for stopping by. And there he goes.
Thank you, Tom. Thank you, Aaron.
You're welcome.
Greg.
Thanks for coming in.
All right.
Always a pleasure. Can't wait to have you back. All right. We are going to move into the 2019 outlook here in just a couple of minutes. But Greg, if you'd like to give everybody maybe a couple-minute update on the Canadian markets, I know they are open today. And so what do you got for everybody today?
Sure. I have a couple of things that, usually I'm going to show something that rather than getting to kind of each of the sectors, and I can do that quickly. I've got this tab set up here. But the one thing that I think is important to look at always with the Canadian market, one of the quickest things to do is to just stay on the homepage and look at the top 10. And you've got the TSX most active, and this can just, really quick. And what do you see? You see the marijuana stocks are struggling again today, and they've been pulling back for a while. But notice some of these oil stocks are starting to rally. And I think one of the biggest things to pay attention to in the commodity world, so in Gatis's world, he's looking for really long-term returns, and he likes to 1 and 3 year and 5 year stuff. The commodity ETFs never live in that world because they cycle up and down like a yo-yo. And if you're a trader or a swing trader, you're going to like that. If you don't like swing trading, you want to stay away from commodities because it's really you're either in or you're out, but you don't sit on the fence. And so the benefit of these simple things at the front end here is you can quickly look, and what you start to see on some of these, like here's Trican Well or Encana, these stocks are beaten down to nothing. And it's mostly because of the price of oil in Alberta. And once they start to respond, either with improved pipelines or with improved rail cars or the production cuts that have just been implemented, I think you're going to see a big jump in these. And so the one thing I would suggest, looking at the maximum up stuff today, CNQ is the largest oil company in Canada with 1.1 million barrels a day. These things are really starting to move up off the back of the industry cuts. And Enbridge comes out with another 375,000 barrels of transportation late next year. So there's some good stuff going on in the background, even though we still don't have a pipeline to the West Coast. These other things are helping out to really improve the market. And lastly, just quickly, this tab shows you very clearly, right? Here's marijuana stock down 12%, down 12%. Down 10% on another one, down 10% on the big one, Canopy Growth Corp. All of these are marijuana names. they're busted. So anyway, with that, I'll flip it back to Tom, and we can keep going on the market outlook.
All right, sounds good. Well, I'm going to let Aaron go ahead and take it first. We're going to take a look, 2019 market outlook. We haven't discussed it. Greg, Aaron, and I have not really talked about anything. So it's kind of an open forum to discuss whatever we want to discuss as we get ready to head into 2019. So Aaron, you got about 5 minutes. What do you think? What are you looking at as we go into 2019?
All right. I'm just going to really pay attention to like one or two charts. We're looking at this double bottom. Mark Chaikin, as we heard, Gatis is looking for this one to execute. I'm not going to argue with those experts. However, I'm skeptical. I guess that's probably the best way to put it, especially after the decline we had yesterday. I think the only thing, that I think is good is that we, of course, haven't gone all the way down. And honestly, seeing the Canadian markets up today, you never know. All right, but I'm going to get to my monthly chart because I think it says it all. And this one is from, let's see, 1944 up until recent times. And if you go back and count all of the sell signals that happen on a monthly chart, well, it's easy to do so. There aren't that many. So in fact, if you just look at the last 20 something years, we've had 4, and that's including the one we just got. So I'm quite bearish. And in fact, I actually have to turn into Timer Digest. I haven't quite figured out what I'm going to say, but I have to give them my market outlook for the Dow and also tell them, what price levels or point levels I think that the Dow is going to be at. And like I said, when I look at this chart, granted, Tom, I know, it doesn't always lead to a huge bear market, but honestly, even some of these small downward moves, that's like a year of moving downward. Maybe not that much, maybe not like we saw back here in 73 to 75, but it can take a while. And so for me, we are getting a decline. It's coming in. I will feel a lot better if we can keep that rising bottoms trend line. If we can maintain the longer term rising trend, I'd feel a little bit better. But at this point, I have to listen to my indicators. And this particular one has been quite accurate. Even back here in 2015, it's still, we got a little bit of upside first, like we did back here, but ultimately it led to quite a decline. And in this case, it wasn't a huge decline, but it was a decline. And you could see when we were getting ready to come out of it, that's when the PMO started to do its little deceleration and start to turn back up. And that was granted a little bit later, but again, this is a long-term chart and we don't get these signals that often. So when I see a sell signal like this with a PMO top that is now, this one is lower. I mean, and we're seeing higher tops here in the market. It's just, I'm concerned. I think that we're going to be in a bear market. I hope I'm wrong. I truly do. But I think we are going to be looking at some declines in the longer term. It may not be a quick one, but I would be expecting more downside.
Yeah, all right, I got to follow up there for you, Aaron, because I mean, I hear you, and I know your strategy. You have a long-term portfolio that you kind of hold through all seasons and all weather. Yes. So based on what you're seeing here, how is that going to change or impact your strategy at all as you go into 2019? I mean, will you short if we do, in fact, start moving lower, or will you just...
in the short term, I would consider shorting if it's, if we know... Like I said, I think we're going into a bear market, but I need to see a little bit more stability. It's just been so volatile. At this point, I'm trying to sell into strength, divest some of those intermediate term holdings. And I'm contemplating, moving out of some of my longer term ones as well, just because, like I said, before this sell signal, we've only had 3 since 1999. So, I mean, I just feel like, the bell's ringing and hey. So I'm expecting bad news for 2019, guys. I would be looking for, as far as the S&P, let's get to a little bit more shorter term chart. But I would expect to see prices possibly over a year start to come down and possibly test this level down here at 2150. So
Yeah,
not great news, but that's where I'm looking.
Yeah, that would be kind of a mild bear market, to be honest. I mean, with what some of what we've seen, especially when you go back and look at what we had in 2007 through 2009.
Oh, sure. That's not to say that it's not going to go farther, but I would say at a minimum, that's what I'm looking at.
Okay, Greg, you're up. What do you think as we go into the next year? Any thoughts?
Well, I think the bond market especially, I think I've been marking this one for a while, and anybody who's been following the commodity countdown over the last couple of months will probably know that I've been expecting yields to drop, and I had put this as an exhaustion move back here in October. So it's slowly winding its way down, but I think the bigger issue that we've got coming up here is that bond yields are going to drop and prices of bonds are going to rise. I think there's, and on one of my charts I have right in about here, Jamie Dimon says gets ready for 5%. And so it's interesting to just kind of note big statements like that on the charts. And then, you know, almost right after he said it, we go for a 1 month run and then we roll over. But my big PM or my MACD and PPO are breaking on these charts. That tells me that this is going down, not up. And so I'm expecting the bond market to improve in price and drop in yield. The commodity markets, I think, will be hugely volatile. So if you're a swing trader, I think there's going to be fantastic opportunities there both ways. EEM briefly started to break out this week, and I don't know if people noticed that, but when emerging markets break out, it's usually some sign that the US dollar is topping. So I think the US dollar is topping. We've talked about this last week or whatever when I was on the show. But what I'm looking for the most is if the US dollar tops and the emerging markets start to go for a run, we'll have a great run in commodities. We'll have a great run in a lot of the emerging market stocks. And I don't know if it's for months or for, you know, a new 5-year uptrend or something. But a weak US dollar would help the emerging markets get off the back because they have really been hammered. You know, they've been falling all year. And if we just well, I could compare with the US dollar or I could just put up the US dollar. But the big thing that I noticed is, you know, late in 2017, the dollar fell. Late in 2016, the dollar fell. Late in 2015, the dollar fell. And I'm coming in here and the momentum is getting pretty much flat. So I'm expecting the US dollar to roll over. And I know a lot of people think I'm wrong. I'm okay with that. The other thing that I'm starting to see is mining and metals ETFs starting to pick up, which that doesn't usually happen in the face of ETF. So I'm starting to see whatever, let's just pick a stock like Barrick Gold. This mining and metals one has more steel in it, but here's Barrick Gold. So I think it's turning up nicely. There's some room for improvement there. When you start to see those stocks lifting, like if I do a scooter ranking, and I think I might still have it here, but here's the top ranking stocks in Canada under materials, and look at all of these gold precious metal stocks with very high scooter rankings. Now that says two things. One is the rest of the market is weak, but the other thing is that these precious metal stocks are bubbling up to be some of the better performers late cycle here, which tells me that that probably wouldn't happen in the face of a strong US dollar. So I think as the US dollar just kind of, you know, the MACD was flat there, I think that causes a big problem. And lastly, just to specifically talk about the Canadian investor, the only reason I want to say something specific to that is I just want to pull up this one chart, and it's the top one in my list here. But what happened was the Canadian crude oil price never rallied, like literally it fell off the page here recently, and that's as pipelines ran out of capacity, but they've been tight on capacity for a while. So while US crude really went up, the Canadian crude hardly ran up, and the black line here is the Canadian dollar. So I'm expecting it to get going, and if we get any sort of bounce in the Canadian oil companies, there should be buckets of money for investors.
Ooh, buckets of money. I always like that.
So let me ask you a follow-up on your 10-year Treasury yield, or on the yields in general. You said you see them rolling over and going lower. Do you have a target? Where do you think the 10-year could drop to?
You know, I'm not really. I would just wait for my momentum to turn, but it's not a surprise that in November we get a reversal in yields. And a reversal, it can either flip up or flip down, but November is a good month to look for changes in the bond market. So anyway, I think we've got a bigger move coming down, and with there and the overall markets, I think might be a lot weaker. So I think the yields could actually move a lot farther than we think.
Okay. Fair enough. All right. Let me take a look and go over what I'm looking at in the market. I'll be honest. I don't know where the market's going yet in 2019. I'm on a fence. I'm seeing a lot of bearish signals, but we just haven't broken down below a key support level. So let's take a look and step back from a big picture. So here's a 50-year monthly chart. I think this qualifies as big picture.
Yes.
If you take a look at these red circles, the bear markets are circled in red. The corrections are circled in black. Now, you can see that on the monthly PPO, for a PPO on a monthly basis to turn negative, you've got to see some pretty serious downward action for a while, which shows, I mean, you don't see a monthly PPO go negative very often. And when it does, it generally coincides with a bear market. Now, these PPO signals come in late. They're lagging indicators, but you can see right now the monthly PPO is definitely declining. Aaron alluded to it with her PMO and the fact that we've rolled over. That is a necessary step. You can't go below zero until you roll over below your signal line. So that is certainly a first step to at least be concerned about. But we've done this before with corrections. And many of these corrections, you will see that the PPO, monthly PPO will turn lower, but will hold above the center line. So we stay weak long enough to kind of choke out all of that bullishness to the upside and all that momentum. But during these pullbacks, these corrections, we do still tend to stay above the zero line. So that's the first thing I wanted to mention. Just looking at the long-term chart, you know, these monthly PMO crossovers of the center line don't happen very often, and we still have a long way to go before that potentially could happen. Now, if you look at when they occurred, they weren't at the very beginning, obviously, of the the bear market, but they generally occurred before the majority of the bear market happened. So what we'll see probably, even if this is a bear market, I suspect we'll go sideways a little bit longer. The monthly PPO will continue to drop, and then eventually we'll have a big move down, a bounce, and then start to move up. And at that point, we'll probably have a PPO crossover to the downside. Something to just think about. Next up, I'm going to move to a weekly chart on the S&P 500. And when you look at the weekly PPOs, you will see the weekly PPOs go negative during corrections as well as bear markets. So right now we are getting a weekly PPO crossover. I don't like it because you can't have a bear market without a negative PPO, weekly PPO. So this is an ingredient for a bear market. If you go to the bottom, the volatility index during the last two bear markets, I've talked about this a bunch, but during these last two bear markets, the volatility index never went down below 16, 17, that area. Well, recently, and you're not seeing it here on this weekly chart, but we did close, or we opened actually this past, I think it was on Monday, we opened at 16 before we had a nice rally in the market and, drop in the market, and the VIX bounced off of that level. Right now, the fear is there. We've never had a bear market without a VIX above 16. And I don't think we'll ever have one. You need fear in a market. You need that anxiety, and we have it. We have the declining momentum on a weekly basis. So I think the combination of those two things tells us we better be really careful and watch what's going on. We had all of this, though, back in, well, not as quite as much, though, in 2016, 2015. You can see the VIX actually did drop back down during the sideways consolidation below that 16 level. So the VIX wasn't really painting a bearish picture as much as it had during the bear markets. But currently, we just still have this VIX above 16. And I think for now, anyway, we have sideways consolidation very similar to what we had 2014 to 2016. I think a lot of times a big mistake is made jumping prematurely into a bear market or thinking that we have a bear market before we get that breakdown. Now, when we get price breakdowns and we start to break down below previous lows, which we have seen, we go through generally periods of declines followed by bounces, followed by declines, followed by bounces. And for me, the importance of seeing the actual breakdown changes the way that I look at these pullbacks. I do not want to buy a pullback. I want to sell a rally. I want to buy the pullback, sell the rally, and continue to trade with a bearish mindset as opposed to a bullish mindset where you're buying the pullbacks, selling those rallies in an uptrend, as opposed to doing the same thing in a downtrend. I think it's too early to make this call. So as I go into 2019, I could tell you I'm really bullish today, and 2 weeks from now, I could tell you I'm very bearish. So I don't think I can really give an outlook at for 2019. I would simply just watch those that key support level on the S&P. For me, I think 2,500 to 2,582 in that range is going to be very, very important going forward. The last thing I wanted to mention is just on the relative charts in terms of sector performance. So far, everything is still holding up. Yes, XLY versus the XLP has been declining, but that was after a steady move to the upside. So far, XLI industrials relative to the S&P, I think are sitting on a very key support area. Financials not far from a key support area as well. I think so far technology and consumer discretionary still holding up okay. But if we lose this price support and these numbers or these relative ratios start dropping, I think we got some issues.
All right.
All right. So those were kind of our summaries of what we're looking at right now. I would say that Aaron, you and Greg are probably a little bit more convinced of your positions. I have no idea what the heck I'm seeing right now in the market.
Well, it's kind of like, you have to sometimes just step out on that limb, and even if it's cracking, I mean, that's what I always say. But to me, it's just, I'm seeing so many bad things, things that I just don't like or things that are making me uncomfortable. For me, I'm just kind of rather safe than sorry. I don't think I'll be sad if the market makes a decent rally here because I've sold, because I'll be really happy if it starts making its move to the downside.
Greg, what do you think? Oh. And I know, actually, Greg, I know you and I were talking earlier. Maybe you want to pull up. We got about a minute. You want to pull up the chart that we had talked about earlier on the
sure. On the yield? You guys like my sheep, my Rocky Mountain Bighorns. So this is the yield curve inversion that's happened that everybody's talking about. And the big thing, as you notice, like the brown line here is the 10-year, and you can see it really dropping off. And it's that sort of real dip that makes a difference. This was back in May, June. We had this sudden dip here, but they didn't cross. And even in February, you can see the distance between the 2-year and the 10-year was like 70 points. Now it's only 11. So as this tightens down, it creates an issue. But I think the bigger thing to remember is that, Cora Reddy, a guy on Twitter, did some examination of the last 6 yield curve inversions, and I think 4 out of 6 of them had higher S&P a year later. So it doesn't necessarily cement anything really deep. I think the bigger issue for us is the whole globe is slowing. And on all of my monthly PPO charts, there's lots of like 20-year trend lines and stuff, and they've stalled the markets right at these trend lines, and we're starting to break the big uptrends from 2009. So I'm worried that we're in for a rougher next 2 years, and I think we're going to have to do a lot of swing trading rather than long-term investing.
Well, I will agree. Yeah, I will agree with you. We are in a much more global environment than we used to be, and a lot of the global markets are not good right now, and eventually you would think that would have an impact on the S&P. All right, I want to thank Gatis for stopping by earlier, and especially Greg also for chiming in on some of his thoughts for 2019, along with Aaron's. Also want to thank all of you for being with us today. Please remember to complete the survey as you exit. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow with the stock market open again. Happy trading.